Hey traders, welcome to Charts and Coffee. Hope everyone's having a great morning. We are kicking off this morning with a look at the broader averages. Let's take a look at where we sit in front of the FOMC meeting minutes. So those are coming up at 2 o'clock today. So if you haven't already gone through the process of your morning, or if it's not in your process yet, put a step in the overall process that includes, sorry, I'm knocking my garbage can around. Put a step in the process that includes checking out the economic calendar. And what this means is whether it's Forex Factory, Trading Economics, Econoday, whatever it is that you're using, what events have already happened, what events are going to happen that will increase volatility. So today, as we can see, as we're waiting on the FOMC, what we have is a low that was put in yesterday. You can see that Darvis yellow line right there. We have a low that was put in yesterday, which is creating this little Darvis box or channel as it is on my screen. And then I'm looking for movement off support. Now, there's a couple ways we can look at this, right? In yesterday's video, we definitely looked at the way in which we have three big things that are happening colliding this year. We have the election cycle, we have a dovish pivot, and what happens when the Federal Reserve embarks on a lower rate type cycle. And then we have the typical seasonal cycles, the least important of which is the seasonal cycle, right? This tendency over the last 5 years for there to be an abrupt sell-off between basically now, call it Valentine's Day, and the 1st of March or early March. Now, what is also factored into that sell-off? Remember, gang, if we go back and look at the daily time frame and the sort of rhythm that we tend to see, remember that in 2019, which would be part of this 5-year look back, and in 2020, we had two massive sell-offs, right? We have two massive sell-offs. And so when we look at the average behavior, which is what, and I'm just squeezing in more data here to get all 5 years of that information, do yourself a favor. Do not blindly follow the average of the last 5, 10, 15, 20, 30 years of any index, of any currency. Remember that indices, currencies, and treasuries are far more sensitive to monetary policy than they are the tendency to sell off, especially when 2 out of the last 5 years had massive sell-offs at the same time. And I mean, when I say massive, some of the most historically significant sell-offs we've seen. Now, instead, go back and ask yourself, last February to March, what happened? Go back into 2022 and ask yourself, okay, February to March, what happened? And then ask yourself, what was the overall environment of that time? So when we remove the catalysts for you and I changing our mind, like an election cycle, like a dovish pivot from the Federal Reserve, we're actually doing ourselves a disservice by trying to compartmentalize, trying to box behavior into, well, this always happens. And you know what that results in? Probably the dumbest thing a trader could say. And you know what it is if you're in the Sector Secrets Mastery. Sell in May and go away, right? That's about the dumbest thing out there because we've said it so many times. Most traders don't even know where that came from. It actually came from trading out in London, and how during certain seasons, they just go out for horse racing season. They sell in May and go away and bet on horses, right? But anyway, remember that we don't want to get trapped into these little, unfortunately, some of them rhyme, so they're really catchy. We don't get caught into these seasonal cycles overriding monetary policy. And the reason I bring that up is today we get a look at monetary policy. Today we get a look at sort of the behind the scenes discussions that preceded the statement and the press conference at the last meeting. So it's a little bit of a look back. Well, it's a lot of a look back, but it's a little look deeper because if there are any dissenters, if there is more agreement, if the general gist of the voting panel is we want to lower rates, all those things then we have a better chance of, well, that's the assumption, of understanding when the rate cuts are going to come. And gang, the cuts are coming. We just don't know when. And just because they're not happening now doesn't mean they're not going to happen. And please don't get caught up in, but inflation or but this. The only data that matters is what the Federal Reserve says. And right now, they say inflation's coming down. Please do not compare the real world with what it is their data dictates. Their models are not necessarily those of, well, Earth, right? And this becomes something that hurts traders. They're too busy trading the real rather than trading the opinion of the people who actually can control the dials and the levers and the knobs of the monetary policy. All right, so with that in mind, let's go ahead and, oh, charts and coffee is not showing up anywhere. Okay. Yeah, I was wondering why oh, there they are. I think it's kicking in. Yeah, bot, I got the programming done in, for whatever reason, it just hit late. Yeah. Gang, if you're catching it now, the replay will be available as soon as we end the session. All right, so first up is FICO, Panther. You want to know what FICO? So this is, I don't even know what this is. What is FICO? Fair Isaac Corp? Okay. It's in an uptrend. I'd focus on pullback buys, which have actually been working out really well. Here's a great example. Even if I don't know what a stock is, even if it's something that I do not regularly trade because it's not part of the weighting of the sectors or the indices that move the market. I mean, structure is structure, psychology is psychology. So yeah, I would say as long as we're for the most part in an uptrend, that's what a dip buy, that's what dip buys look like. So that is what FICO is showing on my charts. All right. Reinhard asks, let's see, the DPMR, which by the way, for those of you that are not familiar with the acronym, daily price movement range. It's the volatility tool that I use, well, created for swing trading. The DPMR indicators are based on volatility each day of the week or just a few days back. Why is it so powerful in my view? Reinhard, it's a relatively complex look back, but I can give you some general ideas. We look back a few days. Oh gosh, no. Months, my friend. We look back months, many months. When you say vol, it's the volatility, yes, of each trading session specific to each stock, right? That makes sense. And why is it so powerful in my view? Well, you know what? Here's a cool thing, Reinhard. Every morning that I'm here in Charts and Coffee, you tell me, you take a look at the gold zones, take a look at the gray zones, and you ask yourself, gosh, when prices pull back, did they pull back to the gray zone in an uptrend? Right? And not just a well-chosen example. I mean, even take a look at a downtrend. Let's say I'm looking at Tesla. Did the gold zone hold price down? Right? Is it active resistance? So why is it powerful in my mind? Based on my experience, which at this point is over 10 years with it. Because when I'm looking at support and resistance, when I'm looking at where prices could shift, price and volume are very powerful. But when you add volatility to the mix, you're going to see levels. And the power for me is I'm seeing levels that most traders don't even know exist. I'm seeing levels on this screen that most traders don't know could be support. Look at NVIDIA. Do we have a mean reversion here? Hardly. Right? There's been no significant pullback to the 34 EMA, or for those of you that like the 21, there's been no significant Fibonacci retracement of a last major move. What's it been bouncing along? Take a look at that gray area. So that's why I use it, Reinhard. It's earned its spot. It's earned its spot on my chart, and everything has to, right? Which is why you don't see me with different indicators 2 and 3 times a year. This is why I don't have new things on my chart very often, because the process to earn a spot on my chart takes over a year. And the process on my chart, once it gets there, I mean, it's going to be there for a long while because it's survived many seasons of behavior, and it just answers the questions that I need. Yeah. So I'm pretty steady about these things. And most of you, I remember one time I was talking to the members in the Sector Secrets Mastery, and I showed them some charts on a site that I was writing for many, many moons ago called Trading Markets, a million years ago. John and I used to write for that site. All sorts of folks used to. And they said, "Oh my gosh, Rog, the wave is on your chart." Yeah, yeah, I've been doing very steady. This would have been what, 1999, 2000, right? So yeah, I like to stick with stuff. Mm. When reading the FedWatch tool, Aman asked, June data is 23%. No, so the way that works, yeah. So what is that data actually saying? And I'm glad you're looking at it, because this data will likely change again come 2:05. As soon as we get our meeting minutes, we have a moment to digest them. We'll get a whole new set of reads, or at least shifts. So we have to go to May before we go to June. If May is largely a hold, staying at the 5.25 to 5.5, then that's 65% that will hold. But then there's about a 35% cumulatively that we may be at a lower rate come May. Well, then that has to be projected forward into June. So it's not a half point cut. It's a 22% that May was a hold and June is a hold, right? It's a 53, almost 54% chance that we get the quarter point cut. And it's a 22% chance that we cut in May, and now we're cutting in June again. So it's got to be a cumulative look. Yeah, it's got to be a cumulative look. So that's the way I break that down. All right. See, Alex says the Fed does not use earth-based. That's in no way for me to say these are not, in whatever talent they have, intelligent people, but it's really, I'm not going to call them dumb. I'm going to say, or chuckleheads. I do call them chuckleheads. What I am going to say, it's dumb for us. It's dumb for this girl to say, well, this data is correct and they're wrong. Because until I'm writing monetary policy, they are right. Right? Yeah, absolutely. What is a dovish pivot? It is when the Federal Reserve has been hiking, pauses, and is preparing to cut rates, which is what we are seeing being discounted in target rate probabilities. In yesterday's video, for the premium video, my Simpler Central folks, my Sector Secrets Mastery folks, my top tier Outlook subscribers, yesterday's premium video, I went and did a little bit of a trip down memory lane on election cycles and on previous Fed cutting cycles. And a question that I get from time to time is, aren't Fed rate cuts bearish? And I'm thinking, on what planet would that even be a curiosity? But I realize people who like to talk about the markets and not trade them like to say all sorts of things. And one of them is, well, Fed rate cuts could be bearish because something's wrong with the economy. I don't even know where to unpack that. But when we look at the price action that precedes and follows lower rates, there is nothing in terms of equities, lending, borrowing, investment, R&D. There's nothing that doesn't like cheaper money. Cheaper money is a big part of why things tend to move higher. Equities, indices, yields, treasury yields start to drop. The US dollar gets weaker. The euro gets stronger. A weaker dollar tends to then prop up commodity prices, things like that. And, by the way, that's probably a big reason why the Federal Reserve is as nervous as they are, because once you start cutting rates, the currency of that country, the stock of that country, if you will, begins to weaken a little bit. We all know a weaker US dollar can lead to, well, inflation, which is why every boom bust cycle that we go into was inflated by monetary policy and is deflated by monetary policy. They have ultimate job security, right? They messy up the room and then they're the house cleaners. Genius. Why didn't I think of that? So that's really what it is. So we just follow that cycle. We follow what they're doing and we trade according to what they're doing. We don't trade according to what we think or what some talking head on television with likely little to no skin in the game has to say. I mean, that's all television is, right? You all know that, right? Because if you have all that time to make up and go to the studio and yak about the markets, I don't know about you all. It takes time to figure this stuff out. I've been on television. It's a time-consuming thing. I don't do it for that reason. My mom and her friends got a kick out of it. But at some point, the ego trip just isn't worth it. All right. So that's what a dovish pivot is. All right. Next up is the Momo trade dead for now? Oh gosh, no, PK. We just need to wait for the setup. So Momo is just a style of trading that says, hey, if a certain resistance level is taken out, there could be follow through. If a certain support level is taken out, there could be follow through. That's all momentum trading is, and even scalping to a certain degree. So no, momentum trading is never dead. Buy the dip or sell the rip is never dead. It's just, do we have the process and the planning and the patience to wait for those symbols that are setting those things up? All right. So I'm not going to play NVIDIA today. No, no, no. I am not going to play stocks going into earnings. I don't know when that became en vogue, but I shan't. All right. That's a huge volatility event. It's a binary, you're very right or very wrong event. And I will say this over and over again. If you want to trade a stock that's going into earnings, play it 4 to 6 weeks. Take a look. Earnings come out, right? Earnings are coming out. We know it's going to happen. Look back to the 19th of January. Even better, look back to the beginning of January. That's 6 weeks ago. Look at the way in which that thing climbed. That's the sane trade. The rest of it is insanity. It's a gamble. It's a bet. It's very exciting. Trading should not be where you get excitement and where you get action. If you want excitement, go bungee jumping, right? If you want action, I don't know, go to Vegas. But trading should be actually a lot of patience and a little bit of discomfort. And that's why most traders don't do well. They're looking to get that dopamine hit. And to me, playing some binary trade on earnings it's exactly that. There's a lot more sanity in this. And I don't need to prematurely age myself. I'm going to be 53 this year, right? I got enough grays as it is. All right. So what I'm saying is, no matter what, the market's going to belly flop next week. Is that what I said? I don't think so. I don't know. Let's see. Pull up the Fed funds and S&P ECAS says, and say that again. Don't follow, my friend. Pull up the Fed funds. The Fed funds rate. When Fed funds, I don't know if that's an agreement or disagreement. When yields are lower, equities typically are stronger. When yields are lower, the US dollar is typically weaker. When yields are lower, bond yields go down. When yields are lower, traders are looking for alpha in things like tech, not staples and energy necessarily, not dividend yielding stocks. But cuts are good for the market. Are you arguing that with me, EKS? Is that the, are you saying they're not? Hey, you can believe whatever you like. Cool. All right. So what else do we have here? I do want to jump on over to bonds, because bonds have yet to really gain the traction that they need to suggest one of two things. Bonds are always playing one or two games in front of decisions. And this is really what we want to remember. If we're looking at the gray zone, we're in an area where there's a little bit more instability to the upside. Bonds are saying, look, the Fed taking their time is not something that we like, for two reasons. These are two games that bonds are two messages from the bond market. You're taking too long, and higher yields for longer are not good for the economy. And the second part is, as long as yields remain uncut, bond yields are going to be a little bit higher, and that's why bonds are still moving lower. Remember, the yields moving higher is actually the bond market, ZB, TLT, moving lower. So when ZB starts to move higher, TLT starts to move higher, that's reflecting weaker yields. And that's really it. Okay, PK asks, PANW. Okay, let's take a peek. How long to wait? I don't know how long to wait, PK. I know what price I'd like. There's a couple, and how long it'll take to get there, not a clue. Nobody knows, right? 353 would be one level, an aggressive level to buy at. The other one would be about 345. So until price gets to that level, there's nothing for me to do. If it takes a day, well, then it might take a day. If it takes a month, then it'll take a month. But I'm not trying to in any way schedule my entry in terms of when that'll happen. But we know there are certain catalysts, right? We got earnings. So again, I want nothing to do with this, right? We got earnings. So we'll see what happens, right? Right now it's sitting way lower, as you can see. I'm not going to trade earnings. My gosh, gang, I'm not going to trade earnings. Yes, 270, 273, no clue. Let the earnings, wow, that's amazing. Let the earnings kind of, again, I don't play earnings. How long do I wait? Let's just see how long it takes for PANW to set up another buy. I mean, that's always the answer, gang. When do I buy? When is it right timing? When there's a setup, right? I hope that makes sense. That's the discipline part. Please don't let a big candle, I call them T-Rex traders. Wherever there's movement, they start going, right? T-Rex, they look at movement and that's what they're going to go do. Let's be patient. I have no clue, my friend. I think we want to wait for another buy setup. All right. And with that, this is a wrap. I'll see you tomorrow. Same time, same station, gang. Be good to each other.